Hello, everyone. Can you hear me?
Yes, good
Yeah.
afternoon.
Okay, welcome back, everyone. Hope you are having a nice day. I'll take any questions you have. Otherwise, I will. Today, it will be a little bit more PowerPoint than I like to do, but I need to explain certain one or two more things so that it's easier to show that way. So I will first take any questions you have, and then I'll continue on the decision making chapter. Anything to report? Everyone doing? Is everyone healthy? Family doing well?
Yeah, so
Everything's
far.
good.
So far? Okay. Okay. Now, in a second, you should be able to see my screen, which is a PowerPoint. Can you all see that? And can you all hear me clearly?
Yes.
Yes, we can see it and we can hear you.
Okay, good. So yesterday we started with a few decisions like make or buy decisions, and uh, we did few problems as to what make or buy decisions would look like. Then today we will do one more decision regarding evaluate whether to sell a product at a split of point or process it further. So generally speaking, you would only process a product further and then sell it. That is, you will only if you basically make more money than your cost is, right? It's as simple as that. There's nothing very complicated about it. Do you want to sell the product for $10, or do you want to sell it for $18 after processing it for two more dollars, right? So in one case you can sell it for 10, in another case you can sell it for $18. So differential revenue is $8 and differential cost is $2. So you're getting more money than your incremental cost, right? Does everyone understand that simple concept?
Yep.
Okay, so you'll only process it further if your differential or incremental revenue is more than your incremental cost. So here is an example. Fast Track has 40,000 units of partially finished product queue. So they can processing date cost to dates are 30,000. 40,000 unfinished units can be sold as is for $50,000. So they can sell these 40,000 units for $50,000, or they can process further to produce finished products X, Y, and Z. The processing the units further will cost an additional 80,000 and will yield a total revenue of 150,000. So what's the incremental revenue here? Okay, just tell me your gut feeling. Will you process it further or not?
Yes,
Yes. Why?
because you almost double your revenue.
What about what about the profits?
Um,
Wouldn't your revenue go up 100,000 and your costs only go up 50,000?
So if you sell the product as it is, you've got an incremental revenue that is difference between this and this, right?
Yeah.
And you've got an incremental cost. So the difference in the incremental income I don't really like this idea. Hmm. So there's an incremental cost of 80,000 and incremental revenue of 100,000, right?
yep.
So basically you're going up by $20,000. Does everyone understand that part?
Yes.
Okay, so that's what they have shown, that you can sell it as it is, or you can sell it for 150,000 with an incremental cost of 80,000. So the incremental income or the change in income is 20,000, which is the same thing as you have an incremental revenue of 100,000 and incremental cost of 80,000 will give you an incremental income of $20,000. So change in revenue is $150,000 finally minus 100,000 or this is what we also call the incremental revenue, and change in cost is 80,000. So your incremental income so this is your incremental income. Okay. Okay, so that is sell or process further. Next relates to scrap or rework. Again, the same concept. Uh, Fast Track has 10,000 defective units. that cost $1 each to make. Units can be scrapped at 40 cents each, or can be reworked at an additional cost of 80 cents per unit. If the reworked units can be sold for the normal selling price of $1.50 each, what will you do? Should you rework the units or should you scrap it?
I think you should rework the units.
You should rework the units. So again, same concept. If you rework the units, you will have an incremental income of about 30 cents. So you can sell it as it is, or you can sell it at 150. So the incremental revenue is $1.10. Incremental cost is 80 cents. So the incremental income is 30 cents. So that's why you should rework the units. Again, the same concept. If you're making more money than you're spending, go ahead, do it. Any questions here, please? Now, next decision to be talked about is determine the sales mix with constrained resources. Every organization has certain constraints. So there might be constraint of machine hours. There might be constraint of labor hours. There might be some other constraint. And depending upon the constraints, or there might be a constraint regarding the supply, or maybe relating to a demand. So generally speaking, you produce the product with the highest contribution margin. However, if there is a constraint, for example, if there is a machine hour constraint, labor hour constraint, or any such constraint, then you maximize the contribution margin per unit of constrained hour. One of the simplest practical example that I can give is, if some of you travel to Pittsburgh downtown, you go through the tunnels. Those two tunnels, what's happening? Why does the traffic slow down over there every time? Simple reason is that 4 lanes are merging into 2 lanes. Then they are again going into 4 lanes, then again merging into 2 lanes. So that tunnel, the 2 lanes become a constraint. The maximum traffic that can flow through those 4 lanes is whatever can flow through those 2 lanes, that constraint which is there. So you have to maximize the throughput through those 2 constraints, or through those 2 tunnels. In business terms, you need to maximize the contribution margin per unit of constraint resource. So let's take an example here. You make 2 products, A and B, using the same machines. You've got the selling price and the variable cost, so you've got the contribution margin, 5 minus 350 at 150. Can you see this, everyone?
Yep.
So you see 5 minus 350 is $1.50, and 750 minus 550 is $2. Machine hours per unit is one machine hour for product A, and then 2 machine hours for product B. Seems like the machine hour is a constraint over here. So if you produce product A, you will generally make $1.50. If you make product B, you'll make $2. So if there were no constraints, you'll be better off producing product B. However, we have got the machine hours as the constraint. So if you maximize the contribution margin per machine hour, that means if you produce product A, you'll be producing a contribution margin of $1.50 per hour, 150 divided by 1, and you'll be producing a $1 contribution margin per hour for if you produce product B, 2 by 2, right? Is everyone good over here? So in this case, product A gives you a better contribution margin per unit of constrained resource. So you will first meet the demand of product A. Whatever machine hours are left, then you will produce product B. Does everyone understand that part?
Yep.
Yeah.
Yep.
So if there was another constraint, say that you can only produce, say, you can only sell 1,000 units of product A. That means your first 1,000 hours will be used to make product A, and then whatever remaining hours are, will be used to make product B. No, it just said the same thing. So again, you already know what contribution margin means. You already know how you can maximize the contribution margin per unit of constrained resource. Yes, please. Does everyone understand that part?
Yes.
Okay, good. Yesterday, we also did evaluation of a segment or whatever if we want to avoid or a particular segment or eliminate a particular segment. We did that yesterday. Next is whether to keep or replace an equipment. So whether should we buy a new equipment or not buy a new equipment. Again, the decision rule is very simple. If you get enough reduction in variable cost and it is greater than the net cost to buy the machine, then it should replace it. Otherwise, you do not, right? So if you're replacing the machine means you're hopefully expecting certain amount of savings in cost. Otherwise, there is no need to replace it, right? So if you expect certain savings in cost and those savings are more than the cost incurred, net cost incurred for the machinery, then replace it. So in this case, there is a cost of, for example, you've got the cost to buy the new machine is say $100,000. Cash received for the old machine is $25,000. So you get that in hand and you reduce the variable cost by 72,000. So your total decrease in net income is $3,000. So you don't replace the machine, right? Because you're losing money. That's what it is, do not replace the machine. Again, the concept behind all these problems is very straightforward. If you're making money, keep it, do it. If not, lose it. Is everyone good with that, please?
Yep.
Now we'll talk about one or two methods for pricing. One is you can use what we call a cost plus method. What does it mean? That basically means whatever your total cost is, you've got a markup on that, and that will determine the selling price. Simple. So in this case, your total cost is given at say 700,000. If you add these things up, 44 units is the product cost, selling and administrative cost variable. So $50 per unit is the variable cost, and selling overheads are 60,000. Fixed production overheads are 140,000. So you added up all the cost per unit at $70. Suppose the profit margin is 20%. So you add that $14 to it to come to $84. Not that I need to show you all this thing, but just since it's in the chapter, there are little small things. So that is cost plus pricing, generally used in the government contracts. They will, especially in terms of research, for example, many times the government would ask companies like Lockheed Martin to say, develop a fighter plane. So in that case, it is made to the specification, whatever the cost is, you add the selling to profit margin to it, kind of a deal. There is another method called the target costing method. Again, what is the idea behind target costing? You have got a certain product in the market. Now you're going to come up with a similar product. In that case, the market already has a certain price acceptance, certain level of price acceptance. Think about a Coke bottle. When you get a Coke bottle from the vending machine, how much are you willing to pay?
Like $1.25.
$1.25. So from the vending machine, you're willing to pay $1.25. So so obviously the cost has to be, so whatever product that comes in that vending machine, which is probably a close substitute for the Coke, like a Pepsi, it should be $1.25 or around that area. It cannot be, would you buy a Pepsi from the vending machine if it was being sold for say $10?
Nope.
No, because there is an accepted price already. That means that 125 includes your profit margin as well. So your cost has to be say 50% below that or something, whatever your costs are, you should be able to make your desired profit. So there's a target cost that the market is giving you for certain products. So that target cost means for $1.25, when you go to Walmart, you'll get a 2-liter bottle, but you'll buy that also, you'll buy the small one also. It depends upon the circumstances. So the market has given you a certain price for say 2-liter bottle and so on. So market price for an MP3 player is say $80. You want a profit of $14 per unit. So it must reduce the total cost to $66 so that it can have a $14 profit margin. That basically means this becomes your target. If you think that you cannot make the product below 66, then you basically don't make it. But you cannot take it to an extreme, like I think it was done by one of the car companies way back, where they compromise the safety of the product. So if you got $1 million invested, a 14% return of 140,000 will take place when you are able to say sell 10,000 units for a $14 profit. Okay. Does everyone understand that part?
Mhm.
Okay. Another So you can also have a markup as a percentage of the total variable cost. So you got the target profit, fixed overhead, fixed selling administrative overhead. Compared to the variable cost, the markup is 68%. So you can also say that, okay, you want a 70% markup on the variable cost, is if that suits you. So it depends. So you can do it as a percentage of the market. If you do it as a percentage of the market, it's 17.5% of $80. This $14 profit is 17.5%. You can, if you do it based upon the variable cost, it will be at 68%. So $50 is the variable cost, 68% of that you added to it, total is at 884. Just a different way to do it. Other pricing methods that are involved are value-based pricing, auction-based pricing, dynamic pricing. In a value-based pricing, basically it focuses on what the customers value, whatever you are willing to pay for. So if recently, although the government made the COVID vaccine available for free, not free means we are paying taxes on it, means government doesn't pay for anything, it's people's taxes that pay for it. But in that case, obviously, if it was left to the free market, there would be a lot of price gouging, most likely, because many people will add, for them, getting the vaccine would be much, much valuable than not getting it. You see what we're getting to? Means your phone has, say, 1,000 features, but you pay for everything, not just for one or two things. If I probably don't use 80% of the features of the phone, if a same phone is provided with 80% less features, maybe I'm willing, they can reduce the cost and meet a different market segment. Auction-based pricing, basically whatever the bids that buyers are willing to bid. Dynamic pricing, based upon the condition, like the airlines do it. And then also, if you have noticed, Wayfair have you heard of Wayfair? Wayfair also uses dynamic pricing. It depends upon the demand and supply. Hotels uses dynamic pricing for the hotel reservation. If you book 3 or 4 weeks in advance, your price will be much less than compared to if you try to book like 1 day in advance. These days are a little bit different, kind of unusual, but generally that's what they do. We also did special offer decisions yesterday. So we will go to the problems now. I just opened the quiz to see a few multiple choice. Okay. Let's start. I am on quiz for chapter 23. Okay. Here is the question. Number 2, try to do this, please. If you're using these numbers, you can type the answer in the chat. You got it, everyone?
Yep.
Okay, good. So your multiple choice would be more like this. Here is another one. See if you can get the answer matched. I really don't like this stupid tips and tutorials. I've told them so many times. Okay. This relates to whether you will accept the offer or not. Make sure you're able to do it. Basically, now the only thing left is for you to practice the problems. There's nothing for me to do anymore.
I got it. I think.
Okay, everyone got it then?
Yep.
Okay. So your questions would be basically like this. Here is another one.
I got it.
Good. Is everyone okay with this, please? Here's the next one. To eliminate a business segment. Do you see what I'm saying? You basically have to practice more. That's all. Today is April 15th, and will you have questions? Do you want to meet on 20th? Okay, there's no answer, so I'm assuming yes.
Our next exam is our final, right?
Yes. Yeah, your next exam is the final exam, yes. You got about 4 classes prior to that.
Well, I guess the next 3 classes, that'll be a review or
Whatever you
with
want, I
that time?
can basically, if you want to meet, I'll be here. Basically, you'll be doing the problems.
Okay, yeah.
Yeah, if means basically class will not last as long as you've got the problems for me. So I'll explain you whatever you want me to explain. So that means you have to do the work. Don't delay the work, please. Okay, any questions on this one, please?
No, I got it.
Yeah, I got it.
I
Okay,
also got it.
okay, good. Here is replacement of an equipment. Okay, any questions on this one, please?
No.
It's pretty straightforward.
Here's regarding the sales mix.
So for these kinds of questions, is it always going to be all and like all goes to one and zero goes to the other? Or is there going to be times where that's not the case?
Sorry, I didn't understand what you said.
So if we're like seeing like what the contribution margin is there going to be any time where it makes sense for there to be like a number of units made in both ways? Or is it always going to be all one way and zero the other?
No, it could be a sales mix means how many units of one and how many units of other. It depends if there is, and as I said, if there is say an additional constraint in terms of demand of a particular product, say we can just take this example here. So you got in this say they can sell all of the standard and premier products they can produce. So there is no, in this case, there is no limitation. Do you see that?
Yeah.
It can sell anything it wants, but it has a limited production capacity. It can only produce 8 standard units per hour or 4 premier units per hour. and it has 32,000 production hours available. So in this case, you've got the contribution margin per production hour, 200 for standard and premier 120, right?
Right.
So basically what they're saying is the maximum you can produce is 256,000 standard units from whatever hours that are available. But if suppose the demand for standard is only limited to 150,000 units, for example, then what happens? You don't want to produce more than 150,000 units.
So you would produce 150,000 units of the most profitable, or
Yes.
and
And
then
then
the rest of the other.
then you will use the rest of the hours to produce the premier.
Okay, I understand. Thanks.
You're welcome. Does everyone understand this?
Yes.
Yeah, it's basically 32,000 times 8. That's all it is. Because there is no constraint on demand. Okay, here's the next one. Again, a sales mix. Again, it has no constraint on the demand. That's why it's straightforward. You just produce the plush. 4 units times 3,400 gives you 13,600. Very similar to the previous problem. If you understood the previous problem, they should be the same. Any
Yeah.
questions on this, please?
No.
Okay, here is the next one. You see, it is all repeating. Everything is repeating. Once you understand the concept, it is just a repetition. That's why I emphasize that you understand the concept. Has everyone got this, please?
Yeah.
See, you're getting good at it. This is a pricing problem using the total cost method, so cost plus markup. So 25% markup on the cost. And on Tuesday, please, that is the 20th, please do bring problems, questions, whatever you're having difficulty in, any topics you want me to explain again, and so on. So just let me know what you want. Just added all the cost and added a markup of 25%. Is everyone good on this, please?
Yep.
Yep.
Yes.
Number 11 was the direct labor rate per hour. It's a little bit different, but should not be a problem. So I guess I didn't cover that. Did I cover that part? Let me finish that also, time and material pricing. Okay, on the time and material pricing, basically, if you are in the service industry, that's what it is used for. Again, the concept still remains very similar. You've got to follow these 3 steps, basically, whatever your rate per direct labor hour is, because your cost consists of labor, material, and overhead plus any desired profit margin, which is the thing which we have done number of times. So the labor rate is in dollar per hour of direct labor, and it can include a charge of us for other overhead cost. So like when you go for repairing, getting your car repaired, it basically gives you, they basically charge you a labor rate of $60 to $70 an hour. It's not that it is the labor rate they are charging. They're also charging for the depreciation of the equipment, lease of the space, and so on and so forth. But everything is being built into the labor cost. Like, for example, a plumber comes to your home, they charge about $50, $60 an hour. It's not only the labor, direct labor charge, but it also includes charge for the machines that person is using, the gas the person spent, the time the person spent, etc. So it includes other overhead cost as well, which is built into the labor price. Then you compute the material markup, which includes the overhead cost, storing, handling, plus a desired profit margin on the material cost. This is expressed as a percentage. Estimate the number of labor hours and total material cost for services. Using 1 to 3 above, compute the price for a particular service. So basically you add the cost divided by the number of labor hours expected, and then you kind of get over there. So right over here, you've got the direct labor hour cost is say $40 an hour. Overhead costs, say 36,000 overhead costs for 3,600 hours at $10 gives you a total conversion hourly cost of $50. You add the profit margin and you get the rate per direct labor hour. For the material markup, you got the material purchase and handling cost at around say 3%, profit margin of 22%, total material markup is at around 25%. That's what they want. So here is the material markup. Your material was 14,000, 25% of the material, direct material is 14,000. Your labor cost we estimated earlier at $61 an hour for 300 labor hours at 18,300. So you got the 18,300 plus your materials and markup. This is like very good example is your when you go to a car dealer and get for it repairing, getting any car repaired. So they will give you all those things. They will charge you the material cost and including the profit margin and the labor. So you can see that over there. So it is just adding the cost and adding the markup. So that's what it is here. Your actual labor rate is $68 an hour. That's given to you. Then you're adding the overhead per hour. Overhead per hour, overheads is 89,000 and the number of hours are 2,800 hours. So the overhead rate is $32. So to this 68 basic rate, you added this $32 an hour. Then target profit margin is for both labor and material at 20%. So you got the 20% profit margin. So 68 is your 68 plus 32 plus, and the 20% on that gives you $20. Add the profit margin to it, giving you a total of $120 per labor hour. Again, nothing new over here. It's just a different way of, it's for the service industry. When you go to the lawyer, they charge you $200 an hour. It's not only $200 of hour of their charges, but their office, the people they pay in their office, their administration charges, their whatever, all other charges, they have estimated it based upon the labor hour. Okay. Any questions here, please?
No.
Okay. Okay. Just do this one. This should be the same thing as we did last time. These are the costs related to materials. So that's the cost, that's the markup coming from there. And then the profit margin is added up. Okay. Everyone good?
Yep.
Yep.
This was the one that was left at the beginning. Why don't you finish this also? So based on this information, should the division be eliminated or not? So when you see the word 45% of the indirect fixed costs are avoidable, that means what? Are these relevant or not?
Those are relevant.
Those are relevant. So those will be part of your consideration. So your variable cost 155, direct fixed cost we know is avoidable, and 45% of the indirect fixed cost gives you 214,850. And so you are still making more money after covering your avoidable costs. Unavoidable cannot be avoided, so will stay, and it meets. So this 45,150 is going towards meeting your indirect cost. If you close the unit, you will incur the losses. So the division should not be closed. Okay, any questions on this?
Can we go over number 9 again?
Sure. Yeah, first of all, is this done?
Yeah.
I have it done.
Okay. This one?
Yeah, this one. Thank you.
Okay, so first of all, they are considering eliminating window division. So that's the first thing. So the question is what will happen with the window division being closed? So what is the impact on eliminating a business segment would be? So very similar to that first question you had over there. They had reported an operating loss of 112,000. Division sales are 1,180,000. So if you close the division, would this remain?
No.
And would this remain? Variable cost. That will also go away, right?
Yep.
The fixed costs of the division were 255,000. If the windows is dropped, 60% could be eliminated. So basically 40% cannot be eliminated. So which part is relevant?
The 60%?
The 60% because that can be eliminated, right?
Yeah.
So here is the variable cost. Here is the fixed cost that can be eliminated, right?
Yep.
So if you close it, you will lose the revenue, but you will also get rid of these costs, right?
Yep. I understand it now.
So that's why it will decrease the income by 18,000 because
I was just confusing the 60 and 40%. I was using the 40% instead of the 60%.
okay. See, the one cannot be eliminated does not change. That means it is same between the two alternatives.
Yeah, I got it now.
Okay. Okay, guys. Any other question for the time being? I've got another 3 to 4 minutes.
I'm good.
Okay, I'll see you on Tuesday. Please bring your questions. Take care. Bye.
Thanks. Have a good day.
Thank
Thank
you.
you.
Bye.